I had to jump in before the interview starts with Ethan to clarify one thing that he brought up after the podcast was over. He talks about wanting rates to stay high, and he wanted to make sure that he didn't come across as it was anything selfish on his part. What he wants for rates to stay high is he wants people to be able to afford houses, and he wants a healthy, balanced market. And he felt like he didn't clarify that well enough in the podcast. So with that said, please listen with that in mind and that context. Enjoy this podcast with Ethan Flynn as much as I did.
I was like, name my price. I don't want to sell it. And they were like, name your price. I got hooked on trying to understand what the market was doing. You have more choices today than you had yesterday by a long shot. You will have more choices next week, and prices are dropping. Yeah, it was beautiful. So yeah, I love the property.
Well, take me back through the deal real quick. I think this is a great intro because like this is you basically not first stab at real estate investing, but it's a hell of a stab. Like you just picked up the biggest sword you could and just
Yeah, it was like, hey, I bought a house. Well, that was cool. Then we bought a duplex. It was like, that was cool. Why not buy a 24 unit apartment,
Yeah.
Which was totally, I was intimidated by the whole deal. I was intimidated every step of the way. I just couldn't stop. And there's something very addictive about doing something where you either hit a home run or you get zero. It's like I can do a lot of work, which I did a lot. I mean, a lot. Hours and hours and hours. I would call my friends. I'd make them look at it. I would call people and just be like, hey, what do you think about this? Well, let me start. I'll start from the beginning.
Yeah,
if you want to
give it from the beginning.
So it was COVID. A lot of the low interest rates had created this gap between, what something would rent for and what it would, what you could, mortgage payment would be. So it's like everything was cash flowing. And so, which had me so excited because I had discovered real estate just a few years before in 2015. And so by the time this started, I really wanted to buy something. We were in a situation where we couldn't necessarily buy something. So we had kind of this roadblock, didn't have a huge amount of money. And we had, with some medical situations, we weren't able to really like go after something, but I had to buy something. It was just, it's 2020. And so
everybody had the same thought. Oh, I'm going to buy an Airbnb or I'm going to buy a 24-unit apartment complex.
Everybody did.
Yep. All right. I won't get you off track again. Keep going.
Yeah, no, it's great. It's great. Anyways, my sister called me. She was like, hey, I bought this quadplex, but the lady that sold it to me also wants to sell her 24-unit apartment. And I was like, oh, I'll talk to her. And so I call her up and, I hear you want to sell your apartment. And we go through, I ask her questions that I think are important at the time. I try to get the rent roll and model it out and figure out. I called mentors to look at it and this is a pretty good deal. $1 million. She wants $1 million for a 24-unit apartment in rural East Tennessee. And so I really wanted to buy this deal, but we couldn't, and we didn't have money to do it. Everybody says when you don't have money, everybody says, "Oh, seller financing." And what I found was that a lot of people may be willing to do that, but there's a lot of people that just want to take a check and go home. And she was ready to retire. She did not want seller financing. She actually got really mad at me when I mentioned seller financing. She realized I didn't have any money. So I was like, "Well, that was embarrassing."
Happens a decent amount of the time because that's the perception as well, is the reason you need me to carry this is because you don't have any money, which means we shouldn't be having this conversation.
Right. Yeah. It was embarrassing. I could have quit. And the thing about it is I could have quit then. Nobody would have cared. There was nobody in my life that was like, Ethan, how's that deal going?
Yeah.
Zero. In fact, people were a little bit judgmental. Why are you wasting your time on this? And I could go into why, but
we're going to talk about that at the end.
Yeah,
for sure.
So it wasn't like but I couldn't. I was like, I got to figure this out. So I text her and I'm like, I'm still working. I've got another plan, which I didn't, but I was like, I've got some other things I'm working on. Now I got to figure out what those other things are. So I just keep making calls, and finally someone's like, well, why don't you get her to finance the down payment? And then you get the bank to finance the rest. That way she'll get paid, but you're still getting seller financing, still zero cash for you. And I was like, I mean, I thought that was the craziest. I did not think a bank would go for that because I was so used to being in the residential space where you can't be creative at all. And so I shouldn't say you can't be creative, but not like you can be in the commercial space.
Yeah.
And so I mentioned that to her and she's like, yeah, that's fine. I'll do that. So we end up buying this property. Well, I shouldn't say we buy. I still had a problem, which was I couldn't buy this property by myself because of the situation we were in. So I got one of my friends who had been looking at the model with me. I'm like, hey, look, I've got a bank. I've got a property manager. I have a property. It's a good price. I have mentors telling me it's a good deal. Will you just take the mortgage and
lend me your credit?
Yeah. Yep. Take 100% of the risk.
Yep, absolutely.
And he was a great friend because I pitched this to investors and, they were all like not interested, which I thought was also shocking. That
you pitched it to the wrong people.
I clearly, and I probably didn't okay. To give them credit before, first of all, they don't know me. All right. They've only met me on Zoom. This property is 4 hours from their investment network.
Okay. You're probably right. Maybe I jumped to conclusions too much.
And, it's out in the middle of nowhere. Who is this guy? And he's got this rural property. It's supposed to be some great big deal. So they pass on it. So I can't be too judgmental, but at the same time, they missed out,
Yeah.
So it makes me happy a little bit, But so I got my friend who had been really studying this with me because I would call him every day on Zoom and be like, look what I got. Look at the updates. So he does it. We buy it. And there were some basic questions I didn't ask. And I'm pretty embarrassed about it. But one of the questions, I asked for the rent roll, but I didn't ask if anything was current. Okay, 30% of the people weren't paying at the time I got this.
Yeah, why do you think she wanted to sell it?
Yeah. So she was tired. It had a lot of deferred maintenance. People weren't paying. She was managing it herself. She was tired.
Yeah.
So she wanted to take her check and go home. It was probably at the time, it was probably worth 1.2 to 1.3 realistically. And we were getting it for $1 million. So we were getting a good deal on a property that took active management and a plan. And the one thing I was good at is financing a plan. But we did have some surprises. And so fortunately, it cash flowed on day one. Every bit of cash flow would go towards something to make the property better. So we didn't take any distributions. In fact, we realized it was going so well that we kept putting whatever we had into it. By the end of the first year, we had combined put in about $70,000 of our money into the property. Which
is like nothing for a property that's 24 units.
24 units, yeah.
Kitchens,
that's right.
24 different types of air conditioning, whatever the thing is.
That's right.
Like
it wasn't, we were just trying to, every unit that came up, how can we make it nicer? How can we raise the rents? Because we knew the market. And so by the end of the year, inflation was at 7%. I realized that we had a seller finance note that was going to come due in 3 years. We had a fixed note that was coming 5 years. We were 100% leveraged. And even though rents were going in the right direction, we had some cash flow crunches coming up in a couple of years that I had to pay attention to. And again, we didn't have any money. We were doing this all with our W-2 income and whatever else we had. And so we ended up not being able to, we were looking for fixed rate debt for 30 years. And that was very difficult to do.
Yeah, it's almost impossible.
It is. You have to be really connected to,
you
just talk to somebody else who knows how to do it. I couldn't find it, but we ended up getting an offer for 2.5 times. I was looking for other properties to buy and I start telling somebody about the property I have and they were like, name your price. And I was like, name my price. I don't want to sell it. And they were like, name your price. So I call my buddy up and I'm like, what's a ridiculous price? And then let's add some to it. 2.5 times what we bought it for.
Dude,
1 year later.
Okay. That's what I was going to say. So you essentially did a flip.
We flipped it.
You did a flip
on accident.
And you made 150%.
We made an infinite return as Ken McElroy.
Purchase price of the property.
Yeah, that's right.
Insane.
It is insane. It was totally insane. It was totally, a lot of that was luck. We had looked at this and had a 10-year, 20-year plan for it.
Yeah.
And what happened in 1 year was really, and that's kind of what our thinking was, to be honest with you, is can we get 10 years of cash flow? If we can get 10 years of cash flow, why are we holding on to this? Surely there's a better place to put it.
Right.
it's a bit arbitrary. Why 10 years of cash flow? I don't know. I mean,
Yeah.
but at the same time, it's like I could wait 10 years to get this, or I could get it all in one kind of setting.
Net present value of money.
That's right.
Yeah.
Exactly. Of course, at that time, everything was free, so there's not much of a discount, but now it really matters,
Dude.
So
that's a crazy credibility builder right off the bat.
Yeah.
It's the fact that you didn't know what you were doing.
Yep.
You took imperfect action. You didn't even have all the information. Like, you didn't know that the people were behind.
Yeah.
Because you just didn't ask.
That's
but
right.
You still just kept going, and then you closed it,
going.
and then you just hit an absolute grand slam.
Yeah.
That's crazy.
And we were conservative in our underwriting. So even though we missed some very obvious things that we should have had, like, we were planning for things that we would miss. And I think that helped us a lot too. But our property manager was good too. She was very effective in communicating, like, if you want to live here, you have to pay, which I think, unfortunately,
how
like,
is that, like, not the very baseline?
It was COVID. It was COVID,
Yeah.
so it was crazy. So we only had one person not pay. It was basically like, you're forgiven, like any back pay. You don't owe it to anybody. You owe it to her. You don't owe it to us.
Just
so
get
clean
started
slate,
again.
but you got to start paying rent.
Yeah.
Which was nice for tenants. It was really good thing. We only had one tenant who could afford. They decided they didn't want to pay rent out of, like, some kind of statement, and it's just, I guess, it's kind of strange, but
yeah, those people go far in life. So
yeah.
All right, so shift over. That's an amazing story.
Yeah.
So shift over and tell me a little bit about you. Just give me like a 3-minute. Who is Ethan Flynn?
Yeah.
Because you're not like a full-time real estate investor.
Yeah. No.
And you're a data guy. Like, so I want you to tell a little bit about that, because I think that that's really what the core of why I found your channel really important.
Yeah.
Like, not just informative, but actually important, is the way you break down the data for a market that we're full-time in.
Yeah.
So yeah,
that's cool.
Give me a little
Thanks for
rundown
saying
for
that.
Yeah.
So after we had these real estate experiences, I got hooked on trying to understand what the market was doing. And I also had a little bit of a confidence boost, obviously, as these things were going on. I was like, okay, I feel like I can at least talk about the subject with some credibility.
Yeah.
And so I was frustrated with all the resources out there. You look at Redfin, you look at Zillow, you look at reporting from, like, the Greater Nashville Realtors Association or any other association. And what I found was that it was very surfacey, and nobody was really talking about how things were trending, which was kind of more important to me, is like, not necessarily what you're seeing today, but what are you seeing today relative to where it was yesterday and last month and 1 year ago and 5 years ago, and how can that inform what might be happening going forward? And that was very interesting to me. And so, because, Redfin sends these, like, algorithmic feeds, where you don't really know if your prices are dropping or if they're just sending you an email with all the price drops. So it's like, am I being manipulated by the data? So I started a journey of really knowledge gathering and trying to understand. And then I started sharing that on YouTube. And what I found was that people were very interested in the same subject. It was a small crowd, especially at first, but people kept coming back, and they were particularly coming back for what I was saying about the real estate market, and which was kind of cool, and I just happened to start doing it at a time where everybody was saying the market, isn't going to drop. And I was saying, hey, but our inventory is moving parabolically, and we're all behaving like how everybody describes a bubble in the past. So I think it might be dropping, guys. And my message then was that you're getting more inventory parabolically. If you're a buyer, you have more choices today than you had yesterday by a long shot. You will have more choices next week, and prices are dropping. So take your time. You don't have to buy right now. There's no urgency, which is kind of the exact opposite of what everybody was saying. Well, inventory is so low because, again, if you look at that timestamp, you don't look at the trend, you don't see a parabolic move in inventory. And so, that message really kind of created a channel for me. And it ended up, people started reaching out and asking me to help them buy real estate. And so that's where I am today. I was like, well, I can start helping people buy real estate. So
nice.
I thought that'd be fun,
No, it's great. It's yeah. I mean, it's like I said, the reason I found your channel appealing was I feel like you have a very sober view I don't find you to be doomy and pessimistic. I overall, I don't feel like you use a lot of hyperbole. Like, I feel like you're not, like the flames in the background of the thumbnail, that kind of stuff. You can use it if you want to.
No, it's fun. It's fun to be sensational sometimes.
Of course it is, of course. But I just don't, I find you to be like, hey, here's some stuff I'm seeing in certain areas. And that's the other thing is you'll go into details inside of Nashville because it's not just like the macro of greater Nashville. You'll literally go into neighborhoods or even condo buildings. Yeah. And you'll be like, here's why this looks like it could be a problem. And, and you'll compare that one condo building maybe to a few others. And I really appreciate that. Just as somebody who's local. So like, even though you're like, the channel is small, the value that you provide to people that are local is, to me, it's pretty great. Like every time you have a video on.
Yeah, thanks.
Me and my wife watch it. My wife wants to meet you, by the way. She's like,
that'd be great.
Yeah, absolutely.
That's awesome.
Absolutely.
Thank you. I appreciate that.
So I'd sent you kind of a list of questions.
Yeah.
And it was basically just like a random smattering of all the things that I was like, if I could talk to this dude, here's some of the things that I'd ask.
Yeah.
And I cleaned it up a little bit.
Sure.
And I think we can just kind of dive in and take it. And if there's anything that you're like, I don't know, or let's reframe the question, totally just reframe.
Okay.
All right. For housing, have we made it through the hard part already?
We made it through the hard part.
Like, have we made it? I'm hearing a lot of macro people be like, we've achieved soft landing.
I can't stand when people say that we've bottomed, especially in commercial real estate. I think it's silly because nobody knows. Here's what I'll say for residential, because that's primarily demand is still dropping. So at the beginning of the year, I would have said maybe. So in December, what we saw for the first time in 2 years was that contract volume and subsequently closed volume was actually exceeding year over year for the first time in 18 months. And so I thought, are we bottoming? Have we found like a trough? And the answer is no. So since then, it's actually started dropping again, which is pretty alarming to me. So until you see a bottom in transaction volume, not price, just closed volume, until you see a bottom in that.
Okay, so that's the metric that you like. Overall, just transaction volume has nothing to do with.
Yeah, because the way I think about it, you have a pool of buyers, okay? And it's hard for me to know if that pool is getting larger or smaller. But when you see closed volume dropping year over year over year with the same mortgage rate, these mortgage rates are essentially in the same spot they were really since 22, at the latter part of 22. Okay, they bumped up into the mid sevens. They've gone up as high as 8. They've gone as low as 6.25, but they're kind of just bobbing up and down in that range.
Because it was brief that they're going and pegging that, and then they'll come back down a little bit. Yeah, but you're exactly right.
Yeah, so what's disturbing to me, is if you have transaction volume shrinking, that means that the pool of buyers are shrinking. And so if the pool of buyers are shrinking, but the pool of sellers are growing, that's like kind of disturbing. Like, why would sellers, and I came from a distribution background, so I helped with the wholesale distribution. I would help buy inventory. Like, you buy inventory for the demand that you have. You don't buy inventory for the demand that you had 5 years ago. People reminiscing on 2019 inventory. Okay. Is really unrealistic to me, because the housing market's spoken. We don't need 2019 inventory. Demand has dropped 30% from where it was in 2019.
That's I haven't thought about that. Mm-hmm. That's an interesting new piece of information.
Yeah. So I'm looking at transaction volume. If we can see transaction volume meaningfully go up, like that to me would say 6%, 7% mortgage rates. That doesn't matter. Like the market has spoken, and there's more demand today than there was yesterday.
Okay. All right. That's a great answer to that one. Mm-hmm. How far down? Let's see. I have UFO written in here for some reason. I know that is just a typo.
We talk about UFOs.
Exactly.
I can go conspiracy anytime.
Where do you think we have to land on interest rates for us to kind of reach a sweet spot where real estate in Nashville in general? Mm-hmm. So I'm talking from 0 to 500, 600,000 houses, and then on up. They're starting to casually appreciate again, mm-hmm. and we're seeing the basically coming out of that trough as far as transaction volume goes. Where do you think interest rates have to get to hit that? And you may not have an opinion on that. I'm not sure.
Yeah, I actually don't.
I I wondered if there was something with, like, I've heard the Reventure guy talk a lot about the issues with basically incomes, average income for an area versus average house price. And then, obviously if interest rates are coming down, that monthly payment is coming more in line with that. I don't know if that's something that you've ever looked at.
I do think of it from a payment standpoint. So 60%, and this is a national figure, so I don't know what it is for Nashville, but I would say it's probably close to the same. 60% of all homes have mortgages. Okay, it's 65%. Maybe it's, size 2/3. So when I think about payment to income, mortgage payment to income, and then rent to income are kind of the two metrics that I pay attention to. And so I generally agree with Reventure in the sense that, like, when he calls these markets overvalued and you index it to where incomes can afford those payments, I generally agree with like his thinking there. I think it's less important about interest rates, although I would love to see interest rates go up personally.
You'd like to see interest rates go up?
Yeah, I would.
Ooh, okay.
Yeah.
Okay, interesting.
I would personally, but and I could explain. We can dive into that one in a minute.
We're definitely going to rabbit trail on that.
But it really doesn't matter. Interest rates go up. You have kind of these levers. You have price. You have rates, the cost of money, and then you have income. Right? Those are in what you can make.
It really is rudimentary. Like that's it.
That's it. Those are the three levers.
And the Fed can literally do three things. We've got all this information, up. We've got all this information, stay. We've got all this information, down. That's it. That's all they can do. It's crazy to me when you think about, like, how impactful it is to the United States economy, and there's just three outcomes: up, stay, down.
Yeah,
all right,
that's right.
Continue the simple levels of real estate.
It really is super simple. The thing that has me, like, kind of on edge is that there's so much migration to Middle Tennessee. Okay, and they're bringing high incomes with them.
Mm-hmm.
And because of that, they're able to absorb the inventory that's on the market. And I do think there is a little bit a sense of a false sense of security in that movement. So if they continue to bring their incomes and they can absorb what's on the market, if that slows down or stops, the people here cannot absorb these prices. So there's a risk in migration. I think historically there's a risk in household consolidation. I've talked about that. People just, multi-generational families living together because they just can't afford the prices. We're actually seeing a lot of that household consolidation now. There's just a lot of migration here. But if that migration slows down, to me, that's kind of a red flag because they're not going to be able to absorb these prices relative to income.
Is that a sign that you're actually actively watching for? Mm-hmm. And then, so what do you have any, like? Are you looking on U-Haul? Like I feel like I've seen that one. Yeah, there was one on.
Well, I don't find any really good information on it. So LinkedIn used to publish a report that showed it showed people with jobs where they were moving from. It was like and they had this really funky algorithm, like how they calculated. But the bottom line is they would show you, like, hey, a lot of people from LA are moving to Nashville. There's a positive net migration. There's been a lot from LA, New York, Chicago.
I feel like I remember that Forbes had some sort of, and you could look at the US map and it was like these little pencil drawings that were drawn, and you could look at the density of the pencil drawings, and then you could click on different spots and it would actually show you where, and it was just crazy watching, like, New York, New Jersey, Chicago, LA coming to Nashville.
Yep.
Tons more going to Florida than Nashville, but it was still kind of nuts to
see
but
outflow. Nashville, the needle here is just so, you're talking about 1 million people, and you just described, if you take all those states, 70 million people coming from those states. So it just doesn't take many people to move the needle. You think about Williamson County, there's 4,000 houses sold in Williamson County every year. It's not much. Yeah. So in the MSA, in the greater Nashville area, you'll have maybe 30,000, probably 26 this year because it's a really, really down year. So 26,000 houses.
Yeah, I actually pulled some of the total houses sold. This is based on GNAR in 21, greater Nashville area, which I don't know how they're designating that either. Like, where are you drawing?
It's
the
9
borders?
counties.
Okay,
it's
so
9
it's
counties.
the whole
So it's Davidson, and then all the 8 counties surrounding. Okay. So you've got Rutherford, Murray, Williamson, Dixon, Cheatham,
Sumner,
Robertson, Sumner, and Wilson. Yep.
Got it. In 21, it was 47,000. In 22, it was 39,000. In 23, it was 33,000. In 24, they were estimating it was 35,000.
Yeah.
So we would have come up. But do you think that it's actually, so when you say it's going to be more, do you say,
and that's condos, multifamilies included in that.
Right. Yeah. That was everything.
Mm-hmm. What's the question?
Do you think that, so you're
2024 will be smaller than 2023.
Okay. Interesting.
And that's why I'm saying like, hey, that's a problem.
Right. Well, another metric that I find interesting that I'm seeing realtors share is median house price still going up. Mm-hmm. And I want to make sure that I understand this correctly. Because what we're seeing anecdotally on our end is when we're listing a house that's 800, 900,000, we'll get that house sold quicker than we're actually getting houses sold for 500. Mm-hmm. And so what I think we're seeing is the first time home buyer market basically having completely dried up at this point. Like all the people that had just whatever, like mom and dad had some money, or maybe they had some money saved. To me, those people are gone.
It's fascinating. It's worse than drying up. It's still drying up. And who thought it could be this bad? It's literally when you look at it, our transaction volume's dropping, but it's dropping in everything under 700,000.
Okay.
So it's increasing.
So that's how median home price can go up though.
That's right. That's right. Yeah. So you've got a larger portion of $1 million houses being sold, right, and you have a smaller portion of under 500, 700 houses being sold. And so you're getting an artificial median there, but it's a mix. Prices are going up, or I'm not going to say they're going up now. They were going up in the spring of this year.
Keep going.
They're not going. I mean, they've essentially stalled much earlier this year than they did last year, which is, it's a warning sign. The market flipped very quickly this year.
Okay. So let's rabbit trail off of my plan here, because I want to talk about you wanting interest rates to stay up or to go up higher.
Yeah.
Explain why.
Yeah. Well, it's selfish.
You're a bad person. You can say it.
It's selfish. I mean, I want prices to drop. Okay. I think the higher interest rates go up, the further they can fall. And I would much rather have a property that makes sense at a higher interest rate. And then, if rates come down, great, I can refinance. If they don't come down, I'm always gonna model any purchase knowing that, like, with the expectations that rates may never come down. We may be in a cycle similar to the 70s. Look, I'm not the most educated macro guy, but you can look in history and there are deleveraging cycles where they just trend up for a decade. So
nobody's ready for that. Like nobody on the investment side there's zero people that are ready for that. I know.
Well, the Fed didn't even, when they did their stress tests, they didn't even model higher rates. It's really funny for the banks. They didn't even model. And I'm looking at it, I'm like, what?
I mean, do you think that they look at the national debt and they just go, we can't. Like, it's impossible. We can't. Like, Bank of Japan just raises a quarter point going from 0 to a quarter, and the world exploded for a week.
So this is really interesting. This is my current theory, and this is my current theory. If the US dollar drops in value relative to other currencies, if you go back and look at 2008 and you go back and look at 2001, there were very different outcomes in the housing market. But if you look at migration and how it changed between 2001 and 2008, migration almost came to a standstill, zero. It was almost zero. And with that, you saw, a flood of new inventory, and you saw, obviously prices dropped pretty significantly. And so part of me wonders, and I'm just wondering, I'm more interested in raising questions on the macro than I am like giving somebody a thesis on what they should believe.
Okay.
But part of me wonders if the value of the dollar drops relative to other currencies, if they're going to lower interest rates, if that creates a shift in migration. We've had these huge inbound migration for the past 4 years as interest rates have come up. Interest rates go down, and now there's not as much pressure on the world to get US dollars, to earn US dollars. And if they go back, let's say just go back to their countries, does that create a vacuum for all the homes we built? And is that maybe why 2008 created such a vacuum in such a capacity? They're like, oh, now all of a sudden we have all these homes. Because everybody always pretends like, you either have, we have a shortage of housing or you don't. But I don't feel like there's really a lot of good data on the immigration to the country and out of the country and the migration. It's always 2 years old before you really know what happened.
Right. And it's still speculative because you're like, how do we actually know?
Yeah, you stop 4 million people at the border, but where are they living when they get here?
Right.
It's a legit question. I mean, 4 million people is more than 1% of the population of the United States.
They said the speculation on like an kind of agreed to on both sides is that in the last 3.5 years, there have been more people that have come into the country than the bottom 40 states. Like the population of the bottom 40 states, not total, but like each individual, you have to get to number 41 in population. Like that has to drive some demand for housing, whether it's rental or whether it's something, but like that's going to bolster some part of I would assume a lot of that's going to be rental.
Yeah.
I mean, I kind of feel similar to you when we're talking about macro, where there's so many factors that can change. And there's some, like if World War III happens and Iran starts nuking Israel right now, like what happens?
Right.
That's a black swan that nobody can predict. So to me, when it's macro, I'm with you that I think raising questions is probably a better thing. But that people kind of hate that too, because they want to know a plan and they want to know how to act.
Well, and that's to me, that's why I raise those questions, is because I want people that are buying to not plan on interest rates falling. If you can't buy and make sense of the current rate, then you should be very careful about buying, because there isn't a guarantee that they'll drop. In fact, a lot of people that bought 2 years ago, we're starting to see stories come out where, you know, their lives have been devastated because they followed a Fed forecast saying interest rates would drop, you know,
or their realtor who said they were going to date the rate, baby.
Yeah. There's one Wall Street Journal featured 2 yeyears ago. Someone in Arizona bought their house. They couldn't afford it without, they said this in the article, they couldn't afford it without the 3-2-1 buy down.
Yeah.
And they've got 2 months and their interest rate's about to go up again, you know, and I'm watching that house. I keep watching it to see if it's going to list for sale.
Oh, that's interesting. So you know the actual address on it.
I do. Yeah.
That's a good case study video.
I'm just watching it though. I haven't said anything yet, but you know, I mean, it's just, you know, a lot of people did the 2-1 buy downs because rates can't stay this high. The people in the real estate market are they think the world the whole entire economic system revolves around them. And that's just not true. There's a lot more at play and so you can't guarantee rates will go down. I think that's very dangerous and you put a lot of people in a bad spot for doing that. And so I've seen the outcome of that. It makes me sad. That's why I'd rather raise questions. So the clarity is not something, it's the message that people don't want to hear. Yeah. But the clarity is, it's super simple. Lock in a 30-year fixed and make sure it makes sense right now. If you can do those things, then it's no problem. Buy. Yeah. But that's not like people want the edge or people want relief. Like the truth is a lot of the real estate investor people that I know, they're starting to sweat because they're 3 years into their 5-year lock. Yeah. And they'll lose the property and they'll lose like they did some sort of GPLP deal with other people's retirement money. Yeah, I know. And I think that, I mean, that's going to be a wave of things, a wave of people over the next few years that I think we're going to see, especially on the commercial side. Yeah. Like your 24 unit apartment complex. Right. We were locked in, for 5 years and we were, you know. And the typical way people would have done that, like if you would have maybe gone and you would have said to your dad, hey, give me 50 grand out of your retirement fund. And then I'm going to go get, you know, Uncle Larry's 50 grand. And then I'm going to go get another 50 from somebody else. And if now with that deal in particular, it would have worked fine because they probably would have refinanced you and you would have been okay. Because obviously, but there's a lot of deals that like they were skinny when they bought them. People were like hoping for a 4 cap. Yeah. It's so crazy. Yeah. It's really sad. Like I think a lot, it's going to hurt a lot of people. So you think that the pain is still coming? I think we're early. I mean, it's just crazy how long it takes. I thought it was coming. I mean, I thought for sure it was coming in 22, and then I'm like, wow, this can't last long. In 23, it was very stable. 23 was incredibly stable. And so that's the other reason I don't really forecast prices. I'm like, I don't know. I mean, prices, they don't make sense at this level, but I mean, I can see why they would come down. But at the same time, the financial engineering and the stuff that's happening in the macro, or it's a little bit, you know, they can decide what they want to do. Everybody's clicking off this video. They're like, he's not giving us any hope. There's no hopium in this video. Well, there are people that are making it work right now.
Oh yeah, there's plenty of people that are. I mean, our rate on our house, because we hit it right at the wrong time when we built our barn house here. We hit it. We bought the land good.
Okay.
And then it took us a while to get everything cleared for us to make the decisions that we wanted to make, come up with the plans. I'm working with my wife so that like we've got to make sure that she's happy and it's not just me going like, I drew a set of plans here, let's go build a house.
Right.
And when we got started, lumber prices tripled.
Right.
And so we hit it at the perfect wrong spot.
Yeah.
And rates at the start of the loan were still low.
That's brutal.
And by the time we got done, they doubled.
Yeah.
I mean, almost doubled. But so I've got a 10-year lock on this place.
Nice.
And I've got 8 years left. So like I feel like okay. But the other thing is, as long as everything maintains on the other side and I don't lose all the assets that we've accumulated, I could do this the rest of my life. Mm-hmm. So like there was no date the rate. I literally was like, is this acceptable?
Right.
And I hate how much interest I'm having to pay, but it was an acceptable amount because probably we could have gone out and bought something that was twice as expensive. We just have tended to be more conservative.
Yeah.
But I know so many people that like if rates don't come down, if they don't, there's going to be bankruptcies is what's going to happen. There's going to be people that will lose all the money that they made over the last 5 years because they went and flipped a couple of houses or bought a couple investment properties that now they can't refinance because they're the banks are like, there's no equity here.
That's right.
There's no equity.
And even if there is even if there's income, the equity's gone. Even if they have the same income.
Yeah. Because of the new rate, that's the thing is that you're recalculating, especially on a commercial piece of property.
Yeah. There's a lot of demand in Nashville. It seems to be much better here than other places. I think other places, it's already hitting really hard. In Nashville, I haven't seen many high profile defaults.
Are you looking at any other markets like, Austin is a really interesting one because there was so much net migration into Austin, but they're still losing. Now they're just losing value. And there's kind of 10 to 20% across the board going down.
That's right.
Are you looking at any other macro markets?
I pay attention to a few markets, Las Vegas, Austin. I'm looking at Florida. And then California, I don't pay a whole lot of attention to, but it's a feeder market for us. So it's kind of interesting. It's something that I have on my radar. Las Vegas has done, up until this point, has done much better than Austin, which is interesting. Las Vegas is a huge feeder market from LA.
That's what I was going to say. They've got a lot of people that come out of LA.
Yeah. So I'm paying attention in the LA market. If it impact Nashville if it drops.
Interesting.
So I don't know the answer to that.
Okay.
I kind of think like in Williamson County, is like in my last video, does the stock market impact buyers on the $1 million? You mentioned your higher end properties, much easier to sell than the lower end properties. Does the stock market impact the higher end properties?
It seems like it would have to, because if people feel poor because the stock market is dropping, they tend to not go.
That's right.
They tend to not consume.
Your savers. Yeah. Or they might do a flight to safety. I'm going to put myself in real estate and get it out of stocks.
That's interesting. But then they're putting it in income properties and they're not necessarily going and buying like the stuff that we're building and selling is stuff that you're going to live in.
Okay.
So for now, we're shifting over a little bit. All right. So tell me how, like on a data collection standpoint for you, do you have a process or anything that you're following that you're looking through? Can you just run me through that?
Yeah. Every morning I get up at like between 3 and 5 because that's just when I wake up. It's when I wake up. Okay. I'm not.
So you're ready for lunch right now. It was 9 a.m. when you got here. Good grief.
That's just when I wake up. I don't set an alarm, but I also go to bed really early. We put our daughter to bed and it's like half the time I fall asleep, at 7 o'clock. So
wow,
it's crazy.
I'm
a weirdo.
You're an old guy.
Yeah, for sure. Dinner at 3. It's pretty bad. But so I get up and the first thing I do is I go through every single county and I just download the RealTracks data. And I have a Python script that I created from ChatGPT and I just run it. Here's the downloaded data. Can you recreate the chart that I created yesterday and plot that new point on there? And so the first thing I do is I look at active listings and contract volume contract volume over the past 31 days. So it's literally like if you got into RealTrax and you just downloaded what's under contract between yesterday's date and 31 days ago, that's all it is. And just plot that every single day. And so what that does is it gives me an idea of how it is. I've been doing it for 2 years now. So I have this like really incredible data.
Yeah.
And I look at it from greater Nashville's all 9 counties that we just talked about. And then I look at each individual county. And so I primarily spend most of my time looking at active listings and contract volume, not so much price.
That's so interesting. Okay, but I get it because you explained why. So that makes total sense why you'd pay attention to those metrics.
The next thing I look at is then price cuts because I've found that to be a really strong leading indicator, which is something I didn't know. I've been watching a lot of the Altos videos. That guy's incredible. He's been doing this much longer than me, and he has some major insights every time I watch his videos. So I look at price cuts and I model those between what happened last year and this year. Or in Davidson and Williamson, I have 2 years ago. So I look at year over year over year. And they've been very good about forecasting prices. So we're going to see an unseasonal drop in prices on the back half of this year. But the thing that people don't realize is that unseasonal drop in prices is happening right now. It's not like, oh, let me wait for that to happen. I don't know what's going to happen in 60 days from now. But I can tell you what's happening right now is that prices are starting to get soft. And the people that are making offers are being aggressive, and those comps are coming in over the next 60 days. So you think about it, what is this, August 13th? You go under contract today, you're closing in September. We're not seeing that until October. So you're looking at a solid 6 weeks. And then in October, you get this report that say prices are dropping. They may not be dropping, Now, I personally think the whole back half of this year is going to be soft. But again, like that data is not in yet. Right now there is data in and it's soft.
Yeah, that's super interesting. That makes sense. So you're plotting everything though on a daily basis.
On a daily basis.
Okay.
Yeah.
So you don't have to do like if somebody's just starting to want to do their kind of research journey, you don't have to do it like every day. I'm assuming it could be something that people could go back and just pull everything once a month for the past 2 years in their local market to say like, how are we trending? And then pull some of these metrics of.
You can do that for price. The thing that you can't do that for, that I haven't figured out a way to do it for, is for active listings.
Active listings on. Oh yeah, I guess that makes sense because you're looking at active listings. Yeah, that makes sense.
So like if you wanted
to do that before, where we looked back at the history of active listings per day, and you're right, you can't do it.
You can't do it, and you can't do it for a specific area. That's why I'm built, I don't use this like quasi built data product that I'm working on, but like, it's really cool because I can pick a neighborhood and I can see, okay, it's August 13th. What was August 13th like last year in this neighborhood? Were there more active listings or less active listings? Were there more price drops or were there less price drops? Was there higher contract volume? Was there less contract volume? There are some things that are hard to find that I lucked out in getting just because I like pull it every day. If you are trying to be practical and you just want to go hunt for yourself, the most practical thing you can do is look at an area, take the closed listings in that area and plot them, preferably like of similar like nature, right? Similar size, same bedrooms, that kind of thing. And then just plot them, put them in a spreadsheet and you create a chart based on price per square foot and sales price, Price per square foot generally works in a neighborhood that's like similar.
If you've got a neighborhood that's within whatever 5-10 years of each other and the houses are within 300 or 400, like an HOA neighborhood,
that's
those
exactly
are super
right.
easy to comp. Yeah.
Yes, exactly.
Those are really nice.
Yeah.
Yeah, I was talking to a guy at Rin last night, and he lives in way up north, rural Tennessee. Okay. And he's showing me one deal, and he's like, "What do you think of this?" And I was like, "I don't know. Show me some comps." And the nearest comp he had was 2.5 miles away, and I was like, "Is that gonna be good? I don't know." Like, that makes me a little nervous. Yeah. I
always look at like even for that, like I get nervous if the monthly payment doesn't pay for the like that. That's like my number one question is, could you rent it for more than the rent payment?
But the answer almost always now is no.
I know.
Almost always.
Oof. I know. But I think it's dangerous. I mean, I don't, you talk to people in California, they'll say, no, that's just the way it is. You got they bet on appreciation. I help a buyer that was negative cash flowing this year, an investor, because that's what he wanted to do. It just doesn't feel like, I can't wrap my head around
You're
it.
creating
I'm
an
too simple.
alligator. Like it's not that you're too simple. It's that you're appropriately conservative. I don't think anybody going in. I mean, unless they have a reason, the appreciation, they view the appreciation is going to happen. Like unless they say the reason this is going to happen is because I know that they're going to build a DuPont plant here that's going to have 50,000 employees. Like I know that's the reason. Okay, I get that. Or I'm going to use this property in 5 years and I'm going to move into it. Like, and then you're not necessarily, that's not even about appreciation. That's about personal use in the future.
Right.
So I think that's a terrible idea.
It just seems so risky. And I am seeing people who are fairly conservative underwriters that are able to find deals. They're just, you have to work really hard. It's not me. I'm trying, but.
Yeah. We're finding nothing in Nashville, just in general. Like it's bizarre. We're working stuff that we'd already closed, that we have, we kind of had a bank of lots that we've been working through, things with weird issues that with Metro that we're having to go and like have backdoor meetings to try to get stuff figured out. Like, hey, can we just figure out a way to make this happen? Like, but not a thing for new people to be able to get in and do any good in Davidson County specifically.
How's the Airbnb? Can I ask about that?
Yeah. It's down. Yeah. So we were lucky the way we did it. We've got 17 Airbnbs and all but one of them were units that we built. Okay. So I didn't take a GC fee. There's no realtor fee. There's no nothing. So when we get done, there was equity, a good amount of equity from day one.
Very nice.
And especially because we'd started building these. I think the earliest one we built in 2014.
Okay. So
10-year-old house. But across the board, there was equity built in from day one. And we purposefully pulled those out because I've got two partners. We've been partners since 2009. And we pulled all, because they were higher dollar, we pulled them each into our individual names and then got 30-year fixed rate financing on them.
Very nice.
So that, because we knew the best way to hold these high dollar properties, lowest fixed rate debt we can possibly get, which is an investment property that's in my personal name. And then we still just keep the books based on it being company property.
Sure.
And
good for you.
Yeah, it's been good. The rents are down and it sucks because, like we made, I think our net profit last year was $300,000 probably on the entire portfolio. Okay. And I bet we'll make 120 this year.
No.
Net profit.
Are you serious?
Yeah. Net profit.
Do you have any of them that are more profitable or all 17 down?
We have two sets that are really close to downtown.
Okay.
That are like, we have one set on 2nd Avenue where you can just take an Uber straight into, like the good part of 2nd Avenue. Right. We're in Chestnut Hill on those.
Okay.
And then we have two in Elizabeth Park. So you can, like throw a stone and hit downtown basically. And those are doing the same as they've always done.
Okay.
And they've been really consistent. But I'll say we've got 4 on Fern Avenue. I don't know if you know where Fern is. So it's north of town. You take Dickerson Road up and it's got overlook onto downtown Nashville. And Fern was basically like a crackhead road for forever. And then all the crack houses ended up being owned by investors eventually. And within a 5-year period, they got torn down. And now there's $1 million houses up there everywhere.
Okay.
It's crazy. And those book like crap.
Okay.
Like absolute crap.
Really?
Yes.
Is it because of supply or is it demand?
It's because there's so much supply on Fern and we're far enough away from Nashville.
Okay.
And then you get like, you'll get worse reviews on those units because of the neighborhood. Like, it feels a little sketchy. You can't really walk anywhere. And if you do, you probably need to bring a gun. Like, we had a shooting there last year where a family rented it for a graduation party. And we were like, okay, that sounds like, okay, yeah, go for it. And it turns out her son was in a gang and 2 kids got shot inside the house.
Are you serious?
Yeah, dude, it was nuts. $50,000 worth of damage.
Oh my God.
They rolled two cars rolled up with 9mm pistols and they put 30 rounds into the house. What? And so like, that's inconvenient. Yeah. That's an inconvenient thing. Yeah. It was nuts.
No,
yeah.
That's crazy.
2 guys got hit and they ran into the master closet and they bled so much in them. Neither of them died. But they bled so much in the master closet that we had to tear the hardwood floors out in the entire master closet, rip the drywall up 2 feet. Like it was like a full on hazmat thing. We had to get rid of multiple beds. We had to get rid of, it was just crazy. So like the dream of Airbnb, there was so many years where we heard people that were like, my wife just quit her job because we have this 400 square foot guest unit in the back of our house.
Right.
We started Airbnb and she made $100,000.
Yeah.
That happens too many times, and the market gets saturated. And
Right.
overnight, you
It
reach
changes.
this saturation point, and then
Okay.
the federal government stops giving people stimmy checks.
Right.
So travel goes down. PPP and idle loans get spent and dried up, and all of a sudden,
Interesting.
yeah. So it's been, we're going to keep holding, because the other thing is where those Fern Avenue houses are, there's all that development that's going to happen on the riverfront right there.
Right.
So we feel like that's still going to be a really net positive to keep holding those. So
Like 5 to 10 years from now.
yeah. So
Yeah.
even if they're alligatoring and they're losing money every month, we're literally going to just allow that to happen, because we look at the body of our Airbnbs as like a mutual fund.
Okay. Yeah.
And
so you
yeah.
take the wins on some
Yep.
and the losses on others,
Yep.
and it nets out positive. Do you ever think about long-term rents in those as opposed to Airbnb, or is it still more profitable to Airbnb? Even though it's,
I don't think they break even. Like, I think
Okay.
that with because of just the price of the mortgages on an $800,000 house, even, I'm trying to remember, there's probably some of them that are mortgage that it would work.
okay.
So we actually had, we have two houses on Argyle Avenue over by Belmont.
Okay.
And one of them was the first house that I couldn't sell as a flip.
Okay.
Bought it for 70, put 30 into it,
Oh,
listed
wow.
it for 135,000 back in 2010.
Oh, wow. You couldn't sell
Couldn't
it.
sell it.
Oh,
Couldn't sell it. 3-bed, 1-bath. And
that's a big win.
yep,
Probably glad you didn't sell it.
didn't sell it. And we just got it under contract for that one and one other one that are on the street for 1.2 million.
Wow.
So
Congratulations.
that'll be a good one, because we may take some of that money and we may roll it forward into another project. We may, we may decide we're going to start paying down some of the Airbnbs. I don't know what we're going to do,
Yeah.
but that was an interesting one, because kind of time saved us on that one. Like, I thought we were just screwed. I was like, oh my gosh, we're never going to figure this out. We're going to have to let this house go back. And then we were lucky. We called a bank and they were like, no, we'll give you a rental loan on it. It's fine. Like, stick a renter in there.
Oh, that's incredible.
And then just
That's
14
awesome.
years later.
Yeah. That was that was your start.
That was the start of building the rental portfolio, other than, like, we all had kind of had other ones,
Yeah.
but when it was intended as a flip and we couldn't flip it, for some reason in my brain, I was like, we screwed up. We screwed up big time, and we're not, and we totally misassessed what this was.
Right.
And I can't believe we can't sell this thing. And so to me, it was like a travesty. But when we did the shift and we rented it out, it was cash flowing from day one.
So it was like a bridge loan or construction loan you had on it, and you had to refi it into a.
Yep. And the bank didn't care. They were like,
That's awesome.
yeah, it's fine. Just stick a renter in there. Like, what do you think it'll rent for? And I was like, what? Didn't
So
even think this was
I
possible.
love that, because you have a plan. You had a plan B. You didn't know it.
Didn't know it.
Yeah.
Yeah. But
That's
there's always some sort of other plan B. And so we've really focused on creative financing over time.
Right.
We've gone to a lot of seminars down in Atlanta and Tampa, and just learned a lot about how to do other parts of deals, which is another thing that I feel like you were one of the first one that I saw that was talking about FHA assumable loans. And I was like, oh, cool. Like, this guy, he gets a certain part of this that the market is not really talking about. Now I'm seeing a lot more listings that are coming up that are saying, like, hey, this might be assumable.
Yeah.
So
Yeah.
Yeah.
It's the greatest opportunity that most people pass on. It's the by far greatest opportunity. And it's not just FHA. It's FHA, VA, USDA, some ARMs. It's incredible opportunity in every price range. I can't get people to really jump into it.
that's so funny. Like,
It's bizarre. In the commercial space, it's the only thing that's selling. Like, you look at commercial properties, and man, if it's not 1 in 3, it's half are assumables or some kind of, like,
it makes sense. But commercial people kind of understand they get it. I feel like what you have to do is you have to go to people and you have to say, would you like to pay $800,000 for this home or $1.3 million? And they go, I'd like to pay $800,000. And you go, cool. That's what you will pay over time. So, like, you look at the total loan cost.
That's exactly
over time.
right. Yeah.
And that's really the only way to communicate.
Well,
it
and
to
I
people.
thought about that. Like, do you do like a net present value? Like, how do I communicate the discount?
Yeah.
And it just seems that people that have, so when you think about people buying in a residential market, if they have enough money to assume a mortgage, They have enough money to buy what they want, and there's just not as much options, so they pass. If you don't have enough money, you would love to assume a mortgage, but finding one that you can afford with a down payment because of the gap between sales price and so you end up eliminating the vast majority of people that buying. And there's a small case to be made for investment, but it's not quite there yet.
Okay. That's interesting. If you see anything like as you're doing some of these, or you see things, just shoot me a text and be like, hey, here's an interesting one. Like here's a thing that I see. Because it may be something that I've got buyers for from, like, we've got lots of people that are coming from out of town that I know from the archery channel. Like,
there's one right now. It's $2.5 million. Mm-hmm. It has a $2.1 million VA loan on it from like, I'm going to say January of 22. So probably 3%, maybe 3.5%. Okay. I would love to offer 2.1 million on just to see if they take it. I would love, but I have to find somebody that's willing to pay, $10,000 a month in mortgage, even though $4,000 a month would be amortization on this loan. Because remember, it's not even a 30-year; it's like 28 years left now on it. So you've got 2 years paid in on it. It's such a good property. But I called somebody the other day. I'm like, hey, what do you think? Would you,
Well, but I mean, so what would be interesting about that one is to tie it up. Mm-hmm. You're a realtor, so you might not be able to do this. You get it under contract to purchase under those terms, and then you try to sell that contract to somebody who's coming from out of town, and then you try to skim $200,000 off of it.
Yeah, no, I'd love it. I would love for someone to buy, because I honestly think it would rent for more than. I mean, it's a high risk market, right? You're looking at tying up $2 million into one house, even though it's just a liability, and even though it's a 3% loan, but if you can, the other part of it is if you could rent it, you'd have to rent it for somewhere between $10,000 and $15,000 a month, which I think is very possible, but it's a very small market,
right?
So
that's interesting.
It's an interesting property,
for sure. Because you're probably right that they would take $100,000 to walk away from it and then let you assume the loan.
Yeah.
So like the barrier to entry on that, right? 3%, 30-year fixed
loan
on a $2 million house
in a nice property in Williamson County.
Yeah, we may have to talk about that one offline.
I love it, man. I mean, really, I love it. I'm like,
yeah, but there's those opportunities up and down the line too. It's not doesn't have to be $2 million. It can be a lot less. And with the market softening, potentially there are people who are willing to now, because I know that the equity spread was a big issue for people.
And it still is. How do you get a second loan on the property? You've got mortgage, if you get a second mortgage, it's going to be way higher than what you're being quoted. It's like 7.25. You probably have to get like an 8.5 or 9%. And that eats away the value of an assumable mortgage very quickly.
So what I'm thinking though, is what if you brought in a partner and you just said, hey, I want to make this my primary residence and I'll split the equity with you when I decide to sell it eventually.
Yeah.
Or do you do something like that where you're actually not having to make more monthly payments on the thing, but you're bringing somebody in who's willing to say, yeah, I would pay, whatever.
I think it would be cool too. And I don't even know if you could do this, but seller finance. So you buy the house, assume the mortgage, and then seller finance it to somebody. And you're just making the spread on the assumable mortgage. It's tricky. There's a lot of rules. So I'm not even saying you could do that. You might want to cut this from the podcast.
No, I'm not going to. because there are legal ways to do that. And there's ways that you can use master leases or ways that you can use options.
Exactly. That's
to do all those kinds of things.
And that's the thing. You have to get very creative. But
no, it's not even very creative. It's literally just like, what's the next step I have to take?
Yeah.
And this is what people don't understand. What's the question you're asking, and find the answer to that question, and then what's the next question? What's the solution? Just keep going until you solve the entire problem, because that's all creative financing is too. Like you see maybe a whiff of opportunity here, and then just start trying to solve the problem.
That's a good point. I mean, that's what happened with the apartments that I bought.
Absolutely, and you took imperfect action on that. Like you didn't know, and you just kept going until you finally figured it out and closed.
That's a great point.
Yeah.
That's a great point.
No, I think that's
so much opportunity.
I know. No, I think it's great. I'm going to talk to the other two guys and see. Yeah. It's even worth just like, I'll sit down at lunch and just be like, hey, what can we do here? Because maybe the answer is nothing. But
Yeah.
is it worth an hour sitting over some spaghetti or whatever and just like being like, how could we take advantage of this on our end?
Yeah.
Or is there an opportunity for us to work something for other homeowners?
Yeah.
But we do that over deals all the time. Like we
Right.
look at all sorts of stuff and we just spitball and see what we can come up with. And
I think that's the fun part about real estate.
Yeah.
It's super fun.
Yeah, for sure. Yeah. Well, especially with a mind like yours. Like if you're an analytics guy and you like all that part of it, like you're putting together a mental puzzle that you're then
That's right.
that you're
Yeah.
then
It's
solving.
just a math problem.
Absolutely.
It's just a math problem.
Yep.
Yeah.
Yep.
And that's fun.
Yeah,
I enjoy
absolutely.
it.
Well, I mean, I think that's probably like this is a very interesting, thorough podcast. I
Yeah,
feel like people will
I
think-
know.
Yeah. I mean, I'm sad that you want interest rates to stay high or go up,
It's selfish.
but overall, I feel like you have a very sober view of the market in general, and I appreciate that about you. So, where can people find you if they're looking for you?
Well, my YouTube channel, I guess it's youtube.com/Ethan Flynn, or my Twitter handle, Ethan Flynn CPA. You can just look me up.
Yep,
Or
and you're
just
pretty
Google
active
Nashville
on
Real
Twitter.
Estate. I'm pretty active on Twitter. I get some days I'm more active than others. I find Twitter to be more entertaining and much easier to get a feel for. I ask a question on Twitter, and if you present it in a way that gets people engaged, you can really learn a lot. And so I've learned a lot by doing that. So Twitter's more of my, testing grounds.
Got
and then YouTube, I'm much more just
Yeah, you're just presenting the information that you found on YouTube.
yeah,
That makes
Twitter
sense.
And YouTube. And then my website, ethanflynn.com.
Okay.
You just go to Ethan.
So if somebody if they're like, I like this guy, he's got a sober view of the market, and he's not going to get me in trouble on a new house, then they can come look at you and use you as a.
They want to be talked out of it. They can they can call me.
This is bad business, sir.
This is terrible. If I can survive another year, I'll probably be all right. But we'll see.
Yeah, it's hilarious.
Yeah.
All right. Ethan, thanks for coming out. Man.
Yeah,
I
no,
appreciate it.
absolutely. It's fun.
All right,
Thank you.
good.
All right.